Good evening and welcome to today's South Market Close Report. Let us start with the key numbers from today's session. The Nasdaq closed at 25,508, down slightly by 0.05%. The S&P 500 finished at 7,443, down 0.19%. The Dow Jones Industrial Average ended at 51,839, down 0.59%. The VIX Volatility Index settled at 18.65, still below the 20 threshold, indicating that while the market is not in panic mode, risk appetite is definitely cooling. The 10-year Treasury yield edged up to 4.6%, and the dollar index rose slightly to 101. The offshore yuan held relatively steady at 6.7681 against the dollar. In commodities, WTI crude oil slipped to $82.66 a barrel, while spot gold remained resilient, holding above the $4,000 mark. Now the biggest story of the day is one word: divergence. And it was extreme. In China SA share market, the Shanghai 50 index surged 3.01%, and the CSI 300 gained 1.53%. But the Shenzhen Component Index fell 0.7%. What does this tell us? It tells us that money is not flowing into all A shares. Instead, capital is concentrating heavily on large-cap blue chips, high-dividend stocks, and domestic demand defensive plays. At the same time, U.S. tech stocks and A-share small and mid-cap growth stocks continue to bleed. What caused this dramatic style shift? Two key drivers. First, former President Trump's remarks about a complete decoupling. Second, new export restrictions on AI chips to China announced by the Commerce Department. These two headlines directly suppressed risk appetite for technology and growth stocks, while simultaneously reinforcing the defensive logic for domestic demand blue chips. So what we saw today was capital rotating out of U.S. tech and A-share small caps, and into the Shanghai 50, high-dividend stocks, gold, and treasuries. Let us walk through the global session step by step. During the Asian session, the A-share market saw an early style shift. The Shanghai 50 rallied independently, but the Shenzhen component fell, confirming this was a blue-chip repair rally, not a broad-based recovery. Growth stocks continued to lose ground. European session data is incomplete, but given that U.S. equity futures were weakening before the open, it's reasonable to assume Europe also traded on the soft side. When U.S. markets opened, the three major indices closed narrowly lower, and futures continued to slide after hours. No inflection point emerged. The only turning point today was the independent rally in A-share large caps, but that signal did not reverse global risk sentiment. Comparing this to our morning forecast, we correctly predicted the weakness in U.S. equities, but we underestimated the strength of A-share blue chips. Our morning report leaned toward continued panic selling across A-shares, but instead the Shanghai 50 surged. The biggest surprise here is that the market seemed to ignore the negative news of China announcing $75 billion in retaliatory tariffs on U.S. goods. Instead, capital formed a consensus to buy blue chips. This may reflect early positioning for potential domestic fiscal or monetary stimulus. Looking at the three-way between currencies, equities, and bonds, we see a mild divergence today. The dollar index edged up, but the yuan remained stable, suggesting that the market is not panicking about renminbi depreciation despite escalating trade tensions. Treasury yields rose slightly, but not enough to create a shock. In this divergence pattern, whether A-share blue chips can sustain their rally tomorrow is critical. If the Shanghai 50 fails to extend gains, today could be a one-day wonder. But if the yuan stays stable, blue chips still have support. On individual stocks, we have no high-conviction opportunity candidates today. For our holding in 5802, the indium phosphide substrate name, it remains relatively resilient, still above its 200-day moving average. Our recommendation is to continue holding but not add positions. On the risk avoidance side, AXTI, the gallium arsenide materials name, has fallen over 50% in the past month, has extremely high valuation, and insiders are selling heavily. We recommend exiting. At the sector level, the strongest direction today was A-share large-cap blue chips, with a 70% probability of continued strength. The driving logic is capital seeking safety plus expectations for policy stimulus. The second strongest direction was defensive assets like gold and treasuries, with a 55% probability. The weakest direction was U.S. tech growth stocks and A-share small and mid-cap tech names, with an 80% probability of continued underperformance. A word of caution, today was the first major breakout for A-share large caps. We need to observe for at least 2 more sessions to confirm this as a sustained trend. Let me give you 4 verifiable predictions for tomorrow. First, the Shanghai 50 has a 55% probability of pulling back, with an expected range of -1% to +0.5%. The core driver is profit-taking, but if domestic policy surprises to the upside, the rally could continue. Second, the Nasdaq futures have a 60% probability of declining further, with an expected drop of 0.5 to 1.5%. The core drivers are the details of the AI chip restrictions and continued rhetoric from Trump. Third, the dollar index has a 55% probability of continuing to edge higher, with an expected range of 100.8 to 101.5. Fourth, spot gold has a 60% probability of trading with a slight upward bias, in a range of $3,980 to $4,040. Let me wrap up with the bottom line. The market is in a structural divergence phase. Capital is rotating out of technology and growth stocks and concentrating into A-share large-cap blue chips and defensive assets. Whether this style shift has staying power depends critically on tomorrow's Shanghai 50 performance and volume. Our strategy recommendation is to stay on the sidelines, or use a mild hedge by buying the Shanghai 50 ETF while shorting Nasdaq futures. If the Shanghai 50 opens lower by less than 0.5% tomorrow with increasing volume, a small long position could be considered. But if U.S. equity futures open sharply lower by more than 1%, abandon any long positions. The failure signals are the VIX breaking above 20.5, or the Shanghai 50 falling more than 1.5% below yesterday's close. That's all for today's report. Thank you for watching, and we'll see you tomorrow.